Welcome to the deep dive. Imagine this. It's April 15th, right? You finally filed your tax return, huge sigh of relief, and then maybe a few weeks later, boom, a letter from the IRS. And it's not a refund check. Nope. It's a notice saying you owe a penalty because you didn't pay enough tax throughout the year. Ouch. So today we're diving deep into estimated taxes and the penalty for failure to pay. We want to help you avoid exactly that headache. Now, this is obviously super relevant if you're, navigating income tax courses or prepping for the CPA section, maybe the enrolled agent exam. But honestly, this is for anyone who wants to manage the money a bit smarter and, well, sidestep those nasty surprises. Oh, and before we really dive in, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, the examples, the explanations we're talking about today, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, a CPA candidate, or already a professional, definitely visit the website for more practice questions, video lectures, and just great support to really hammer home today's topic. Big thanks to Professor Farhat for providing this valuable material. All right, so let's unpack this. Estimated taxes. Who actually needs to worry about this in the first place? Is it, everybody?
That's definitely the place to start. And no, it's not everyone. Not by a long shot. See, if your only income is from a regular job, a W-2 job.
Right, like most people.
Exactly. Your employer usually withholds taxes from your paycheck based on that W-4 form you filled out when you started. So in that typical scenario, you probably don't need to make separate estimated tax payments. Your employer is handling the heavy lifting there.
Okay, but what if it's not just a regular job?
Yeah. That's where it gets a little trickier, even for employees. Maybe you have other income streams, say significant interest or dividends from investments.
Or a side business. That's pretty common these days.
Totally. Or maybe you sold some stock. The point is, your regular paycheck withholding might not be enough to cover your total tax bill for the year. Now, one option, if you want to keep things simple, is just to talk to your employer, adjust your W-4, ask them to withhold more from each paycheck.
Gotcha. So you can sort of prepay the extra tax through your main job.
Precisely. It can save you from having to make those separate quarterly payments and avoid a big bill later.
Makes sense. But what about people who don't have an employer doing any withholding, like freelancers or self-employed folks?
Right. You nailed it. That's a key group. If you're self-employed, running your own business, freelancing, independent contractor, whatever you call it, you absolutely have to think about estimated tax payments, assuming, of course, you expect to actually make a profit.
Because there's no one else taking taxes out for you.
Exactly. Income tax, Social Security, Medicare, it all falls on your shoulders. And this is really, really crucial for everyone listening. You, the taxpayer, are responsible for figuring out how much to pay.
The IRS doesn't send you a bill every quarter.
Nope. No mid-year invoice. It's entirely up to you to estimate your income, calculate the tax, and make those payments. Think of it like the government wanting its cash flow throughout the year, not just one big lump sum on April 15th. It's like a payment plan for your taxes.
Okay, so I get why it exists, but what happens if I'm supposed to pay quarterly and I just don't? Or I don't pay enough? Is it just a friendly reminder?
No. Not quite friendly. There's definitely a sting. Yes, a penalty is imposed for failure to pay enough estimated income tax. And this applies pretty broadly individuals, trusts, certain estates, and corporations too.
Okay. A penalty. How is that calculated? Is it a flat fee?
No, it's generally based on interest. Specifically, the interest rate that the IRS uses for what they call deficiency assessments. Basically, it's interest on the amount you should have paid by a certain date but didn't, and that rate can change, so the cost of underpaying isn't fixed.
Yikes. Okay, so is there any leeway, like if I'm short just a few bucks, do they still slap me with a penalty, or is there a minimum amount I have to be short by?
Thankfully, yes, there's a bit of a safety net, a threshold. For individuals, you won't face a penalty if the total tax you owe for the year after you count withholding and any estimated payments you did make is less than $1,000.
Ah, okay. So under $1,000 short, no penalty for individuals.
Right. And for corporations, that threshold is even lower. It's $500. So let's say you owed, $1,200 in total tax, and you'd paid $800 through withholding or estimates. You're short $400.
Which is less than $1,000.
Exactly. So in that case, no penalty. It's really meant to catch the more significant underpayments.
Got it. And when do these payments actually need to be made? You mentioned quarterly.
Generally, yes. The idea is to pay about 1/4 of your total estimated tax for the year in each quarter. The dates can shift a tiny bit if they land on a weekend or holiday, but the typical due dates for individuals are pretty standard.
Like April 15th is the big one.
That's the first one, yeah. Voucher 1 is due April 15th. That Voucher 2 is usually June 15th. Voucher 3 is September 15th. And the last one, Voucher 4, is actually due January 15th of the following year.
Okay, so roughly every 3 months. Good to know those dates.
Yep, pretty consistent once you get into the rhythm.
Okay, so we know who pays when and that there's a penalty if you're short by too much. But the tricky part seems to be figuring out how much is enough. You mentioned paying enough to avoid the penalty. How do I calculate that as an individual? I think I've heard the term safe harbor.
Exactly, the safe harbor rule. That's your key to avoiding the penalty with some certainty. It's basically a guideline from the IRS. If you meet it, you're generally safe, even if you end up owing a bit more when you file your final return. It provides predictability.
Okay, so what is this magic safe harbor rule for individuals?
All right, for individuals, you've generally met the safe harbor if the total amount you've paid during the year that's through both withholding and estimated tax payments is at least the lower of two amounts.
Lower of. Okay, what are the two amounts?
Number one, 90% of your current year's actual tax liability, the tax you actually owe for the year you're in. Or, number two, 100% of your prior year's actual tax liability, tax shown on last year's return.
So 90% of this year's tax or 100% of last year's tax, whichever is less.
You got it. Pay that lesser amount throughout the year, and you should be safe from penalties. But there's one important exception to that 100% prior year rule.
Uh-oh. Okay, what's the catch?
It involves your adjusted gross income, or AGI. If your AGI in the prior year was more than $150,000,
Okay, over 150K AGI last year.
then that 100% prior year rule changes. It becomes 110% of your prior year's tax liability.
Ah, so higher earners need to pay a bit more based on last year's tax to hit the safe harbor, 110% instead of 100%.
Exactly. It's a higher bar for them using the prior year method. Let's run through a quick example or two. It makes it clear.
Yeah, examples help.
Okay, take Sarah. Prior year AGI was $75,000, so under the limit. This year, she paid $750 total through withholding and estimates. Her current year tax turns out to be $3,000. Her prior year tax was $2,000.
Okay.
First, always check that to $1,000. She owes $3,000, paid $1,750. That's a shortage of $1,250.
Which is more than $1,000, so a penalty could apply.
Right, so now we do the safe harbor check. We need to lower it back. 1, 90% of current tax, $3,000. 2, $2,700 to dollars. 200% of prior tax.
Yeah, $2,000.
The lower number is $2,000.
Correct. So Sarah needed to pay at least $2,000 to be safe, but she only paid $7,750. So her underpayment for penalty purposes is $2,000 minus $1,750, which is $250. The penalty is calculated on that $250 amount.
Got it. Okay, what about that higher income scenario?
Okay, let's look at David. Prior year AGI was $160,000.
Ding ding being over $150K.
Yep. So we're thinking 110% for the prior year rule. He paid $6,000 this year. His current year tax is $8,500. His prior year tax was $6,000.
Okay, shortage check first.
Always. $8,500 minus $6,000 paid is $2,550K. It's 110% of prior tax. $6,000, $6,050 versus $600.
Okay, so $7,650 versus $6,600 versus $6,600. The lower is $6,600.
Right. David needed to pay $6,600 to be safe. He only paid $600. So his underpayment subject to penalty is $6,600 minus $6,000, which equals $600. Makes sense. So that AGI threshold is really important.
Absolutely crucial. And one more quick individual point.
Yeah.
What if your prior year tax liability was zero? Maybe you had a loss or very low income.
Yeah, what then?
Good news. If your prior year tax liability was zero, there was no underpayment penalty for the current year. Period. Doesn't matter how much you owe this year.
Really? That's a nice break.
It is. Kind of a free pass for the year after you had zero tax liability.
Okay, that's a fantastic breakdown for individuals. Super clear, especially with the safe harbor and that AGI kicker. So let's switch gears. What about corporations? Are the rules kind of the same, or is it a whole different ballgame? I imagine big companies have different issues.
It's similar in concept, but definitely has its own complexities. You're right. For corporations, the underpayment is also generally the difference between what they paid in estimates and the lower of their current year tax or their prior year tax. But remember, corporations don't have withholding like individuals. It's all about their estimated payments.
Right, no paychecks to withhold from.
Exactly. Now, using that prior year alternative basing payments on last year's tax has some specific conditions for corporations.
Okay, what are the hoops they have to jump through?
First, they need to have had a full 12-month tax year in the prior period. to use that prior year's tax number. Second, that prior year tax liability couldn't have been zero. There has to be a positive amount. You can't base a safe harbor on zero tax.
Makes sense. Need a real number to work from.
And third, this is the big one for larger companies. We have the large corporation rule. A corporation is considered large if it had taxable income of $1 million or more in any of the 3 preceding tax years.
1 million in taxable income in any of the last 3 years. Okay, what's special about them?
Large corporations can use the prior year tax alternative only for their first estimated tax payment of the current year.
Only the first quarter.
That's right. For the second, third, and fourth quarter payments, they must base their estimates on their current year's expected tax liability. They can't rely on the prior year anymore after Q1.
Wow, okay. So they get a little breather for Q1 based on the past, but then they need to get real about the current year's profits quickly.
Precisely. It forces them to estimate their current year income and tax much earlier and more accurately. Let's do a corporate example, maybe with that large corporation rule.
Yeah, let's see in action.
Okay, imagine Cold Services Corp. Their current year tax liability is expected to be $105,000. Their prior year tax liability was $84,000. But 2 years ago, their taxable income was $2 million.
So they hit the $1 million mark. They're a large corporation.
Correct. So for their estimated payments this year, quarter one, they can use the prior year. So they pay 25% of $84,000, which is $21,000.
Okay, Q1 is 21K.
But their total tax for the year is $105,000. A normal quarterly payment based on the current year would be $105,000 divided by 4, which is $26,250. Since they only paid $21,000 in Q1, they're short $5,250 for that quarter. $26,250, $21,000.
And because they're a large corporation, they can't just keep paying based on the prior year.
Exactly. They have to catch up. That $5,250 shortage from Q1 needs to be made up in the Q2 payment. So for quarter two, they pay the normal $26,250 plus the $5,250 catch-up amount. That's $31,500 for Q2.
Okay, Q2 is a big one to make up for Q1.
Right. Then for quarter three and quarter four, assuming their estimate of $105K holds, they just pay the normal quarterly amount, $26,250 each, if you add it all up. $21,000 Q1 plus $31,500 Q2 plus $26,250 Q3 plus $26,252 Q4. It equals $105,000.
So they end up paying the full current year liability, avoiding the penalty, but the payment amounts were uneven because of that large corporation rule.
You got it. It requires careful planning, especially making that catch-up payment in Q2.
Wow. That's a really fantastic dive into a topic that can seem pretty intimidating. It really highlights how important understanding estimated taxes is, whether you're an individual with side gigs, self-employed, or running a corporation. These aren't just random rules. They're really key for avoiding those penalties and just managing your money effectively throughout the year. It's about being proactive, right?
Absolutely. Proactive is the key word. And the core idea is they really boil down to a few things. First, know if you need to pay estimated taxes. Second, understand those penalty thresholds, that $1,000 for individuals, $500 for corporations. Keep small errors from costing you. And third, master those calculations for what's enough payment, that safe harbor concept.
Right, the 90% of current year or the 100%, 110% of prior year for individuals.
Exactly. And for corporations, knowing the rules about using the prior year, especially that large corporation twist for Q1, knowing these lets you hit that safe harbor and sleep better.
So maybe here's a thought for everyone listening. Take a quick minute after this. Look at your income sources. Is it just the one paycheck? Or do you have other things going on? Maybe you're fully self-employed. If you might need to pay estimates, glance at last year's tax return. Think about this year. Start planning those payments now. Honestly, this knowledge isn't just for CPA candidates. It's really practical for anyone managing their finances who wants to avoid that unpleasant surprise from the IRS come next year. It's about feeling in control.
Couldn't agree more. And remember, tax rules can seem complex, but they're learnable. This is an area where staying informed really pays off, literally. For an even deeper dive, more examples, practice questions, those helpful video lectures that really break things down, I definitely recommend heading over to farhatlectures.com. Seriously, investing a bit of time in understanding this stuff isn't just about passing an exam. It's a smart investment in your career and your financial future. Good luck with it all.